Hi there, my name is Margaret Caraba. I am an entrepreneur and a Forex trader, and welcome back to my channel. In today's lesson, we're going to be talking about Forex terminology. So these are the words we use in our day-to-day Forex trading life, and these are the words that are commonly used when describing things that we do as Forex traders. So I am so happy to have you in this lesson. If you have questions at the end of this lesson, please make sure to comment and ask them on the comment section. Don't forget to like and subscribe, and let's get to it. So quote. A quote is the exchange rate between two currencies at a specific time. The quote is written in the format XXX/YYY, where XXX is the base currency and YYY is the quote currency. An example is the USD Kenyan shilling. So you'll also see that when writing the quote, we use the symbols for different currencies. So USD for the US dollar, KES for the Kenyan shilling. As you've seen, the first currency that is stated is a base currency. The second currency that is stated is known as the quote currency. So when you ask for the quote of the USD Kenyan shilling, for example, currently it's at 105, and this means that $1 is equals to 105 Kenyan shillings. The base currency in most cases is the stronger currency. Another example is of the Euro USD quote. So here we have the Euro as the base currency because it's stated as the first currency, and we have the USD as the second currency, which is the quote currency. And when you ask for the quote of the Euro USD currently, then it is at 1.1045, meaning 1 euro equals to $1.1045. So you can find the quote of a currency pair by Googling the currency pair. So for example, you want to know the quote of the pound USD, you want to know the quote of the euro pound, you want to know the quote of the euro USD. You can easily just Google the currency pair. So the base currency, as we've talked about, is the first currency in a currency pair. The quote currency, as we've talked about, is the second currency in a currency pair. The bid price. Now, this is where I want you to pay very close attention. The bid price is the price a Forex trader is willing to sell a currency pair. Stay with me. So the bid price is the price at which the Forex trader is willing to sell a specific currency pair, and the market is prepared to buy a specific currency pair. So when you're talking about a bid price, if you're talking about the Forex trader, it's the price at which the Forex trader is willing to sell. If you're talking about the market, it's the price at which the market is prepared to buy the specific currency. I hope that's clear. So at this bid price, the Forex trader can sell the base currency. So every time we're talking about bid price or ask price, we're talking about selling or buying the base currency. So for example, in the quote pound USD, what we have here, the bid price is 1.8812. So this means that you sell 1 British pound for 1.8812 US dollars. Now the ask price is the price a Forex trader is willing to buy a currency pair at. So stay with me here. So the ask price, when you're talking about the Forex trader, this is the price at which they're willing to buy the currency pair. But when you're talking about the market, it's the price at which the market is prepared to sell this specific currency pair. Okay? So an example is the quote Euro USD. So remember, every time you're buying or selling, we're talking about buying or selling the base currency of the quote, okay? So for example, in the quote Euro USD, the ask price is 1.2815. This means that you can buy the euro for $1.2815. Remember, the ask price is also known as the offer price or the counter price. So as a Forex trader, in this situation, when we are having the ask price, it means you are buying the euro for 1.2815 US dollars, okay? The spread is the difference between the bid and the ask price. So we have our Euro USD quote, and our quote is currently at 1.2812 for the bid price. and 1.2815 for the ask price. So we are selling at 1.2812, we are buying at 1.2815. So the spread is the difference between the bid price and the ask price. 1.2815 minus 1.2812 will equal to 0.003, and this is the spread. A pip. A pip stands for a price improvement point. Well, this doesn't really matter because everyone will just call it a pip. No one will go by, oh, price improvement point. Well, you can if you're an intellectual. So a pip is the smallest value change in a currency pair. Let me explain. So here we have the Euro USD. Okay, so here we have our quote, and currently it's at 1.1245. So if it changes to 1.1244, then that change, that minute change, is what we call a pip. It can also change to 1.1246. That small value change, that is what we call a pip. So good understanding of pips is extremely important because they're used to calculate your profits and losses at the end of the day during a Forex trading session. So to better understand the pip calculations, please check out the pip calculation and lots video. I have linked it below. I couldn't really do the whole breakdown of pip calculations and lots in this video. This is because the video would be too long. But you can definitely check the video out if you want to learn how to calculate pips, if you want to have a deeper knowledge of pips, which is very important. So a lot is a unit of measurement that measures the amount of the transaction. Again, if you want to learn more about pips and lots, make sure you check out the video that I have linked below. And so we have different lot sizes. So we have the micro lot, which is in thousands, the mini lot, which is in tens of thousands, and the standard lot, which is in hundreds of thousands. We most commonly use the standard lot because it's easier to do our calculations. It's easier to do our pip calculations with it. It's also easier to just like measure our profit or our losses with the standard lot. Going long is the act of buying currency, which usually means buying the base currency. As you said, when we're talking of buying or selling currency, it means we're buying or selling the base currency. So going long means buying the currency. Going short means selling the currency or just selling the base currency. A margin is the necessary money needed to maintain a position, or you can just call it the initial deposit that is required for you to start trading. And a margin call is the request by the broker to the trader to top up his margin account when the margin account falls below a minimum accepted level. So an example, if the minimum accepted level for your margin is $200 and then your margin level falls below $200, let's say it falls to $80, that's not enough for you to trade. So the broker will call you up or will text you or email you in this day and age of texting and emailing, and they will ask you to top up your margin, okay? Okay, and that is what we call a margin call. Leverage. So leverage means borrowing money in order to increase your potential profit. Without proper risk management, you can lose your leverage money and you have to pay it back. So you need to be very careful. On the other end of the spectrum, you can make a lot if you have the right risk management and you have the right skills to trade. You can make a lot from the leverage money, return the leverage money, and keep your profit. A market order is an order to make a transaction at the current market price. Example, we have our Euro USD quote at 1.245. So a market order essentially just means a Forex trader stating that, hey, I want to buy my Euro USD pair at the current market price, which is at 1.1245. I don't want it at 1.1244. I don't want it at 1.1246. I just want it at 1.1245. Okay? Okay. Remember, this goes for both buying and selling, not just buying. I just had to put that out there. A limit order is an order to make a transaction at a specific market price. An example is we have our quote for the Euro USD at 1.245. But I want to buy or sell it at 1.1244. So a limit order essentially is the Forex trader saying, hey, I don't want the currency right now at this current market price. I want it at its later market price, which can be 1.1244 or 1.1246. So it's very specified by the trader. They don't want it at the current market price. They want it at a specified market price. Take profit. So a take profit is an order used by current traders to automatically close their position once a certain profit has been made. Although it stops any further advance in profit, it guarantees a specific profit after that level has been hit. So let me show you what this means. Please note that this example is when going long, so we are buying our particular currency. So we got in at this particular point at the white line. We were going long, so we were buying our currency. So we set a limit, which is called the take profit order, at which we want to take our profit. So when our currency goes up and gets to this point, our trade automatically closes with the profit we specified. Even if there's more profit to be had, then that profit will not be had because you specified that at this particular point is where I want to take my profit. So the trade closes. A stop loss is an order used by Forex traders to automatically close their position to liquidate a losing trade. Essentially, this is risk management. So what happens is that, so you entered this trade and went long. You expected the trade to go up, but instead the market went against you and it's going down. So you put a stop loss order in place to minimize the amount of money that you lose. Like you already know that you're going to lose money, but you minimize the amount that you're going to lose. And that is risk management. Make sure to be responsible when trading and place your stop loss order. Even if you know the market will do well, place your stop loss order. It might just go awry. Well, we have come to the end of the lesson. Thank you so much for staying with me. Remember, if you want to learn more about pips and lots, which is important, please watch that video on the link below. Don't forget to subscribe and hit the notification bell. Of course, I want you to know when new videos are up. I am here to educate you on Forex trading. Until next time, bye!